Hey, this is Daniel. In this video, we're going to talk about finances for Amazon Private Label. So over the past 2 years, Shane has really taught me a lot about this, things I didn't know. He's got a master's degree in finance, and he was really able to merge that knowledge with his brand and his business to make finances like a competitive advantage in his business, right? Because I know for most entrepreneurs, just like me before, if you don't have a background in finance, you don't understand really how to manage finances properly in a business, it can be a weakness. It can be a limitation in your business. It's something that can hold you back. So instead of it being like that, let's turn it into a strength. And that's what I'm going to show you, or what Shane is going to show you in this video. So how can we make finances like a tool and a weapon in your business instead of something that causes potentially stress, limits your thinking, your planning, your vision, and your ability to get results. So what Shane is going to do specifically is going to walk you through like a 4-step process he's got to make the business financially literate and strong and capable. So everything from like tracking, bookkeeping, accounting, things like this, to forecasting, planning financially, and potentially looking at capital and things to inject into your business to grow faster and further. So if you've got a big vision or plan, you want to get there pretty quickly, then you may need more capital than you've got currently at your disposal to put into the business to get there faster if you've got those opportunities. So it's going to show you some options and how to do that as well properly, if that makes sense. These are just a few examples. Doesn't cover everything, but hopefully that gives you a good insight into what you're about to learn here with Shane. So I'm going to switch over to Shane now. He's gonna share these things with you like in a presentation, and I hope you get a lot out of it.
Okay, so today, here's what we're going to discover. As Daniel mentioned, we're going to go through 4 systems. The first one here is cost cut for efficiency. So I'm going to go through the service provider we use in terms of setup in cloud, delegated access, hiring a virtual CFO, one-click P&Ls with some analysis here too. The second one here I'm going to go through is system 2, and that's forecast for scale. So how to effectively forecast for the next 6 months, make the most use of your cash, and with that be able to engineer opportunities, profitability, and so on. The third one here we have is system 3, and that is about cash and reducing risk. So we'll talk about profitability versus cash flow. I'll talk about growing faster with the cash conversion cycle, stock reordering points, whether that is a positive or a negative cash action in your business. And then also I will talk about credit facilities as well. So system 4, what I'm going to go through is your financial leap. So I'm going to briefly talk about the cost of debt versus equity. I'm going to talk about your financial leap. I'm going to talk about company valuation and selling for a high multiple with tax efficiency. Everyone wants to make more money on exit, and we will talk about that towards the end. Okay, so the first slide I've got here is don't ever let your business get ahead of the financial side of your business. Accounting, know your numbers, and that is by Tilman J. Fertitta, a billionaire, Houston Rockets owner, and an all-around great businessman. Okay, so first up we have cost cut for efficiency. This system shows us how to effectively manage our finances in real time, how we set up our bookkeeping rhythm, service provider workflow, and how to plug your team into it, hiring a virtual CFO to create weekly cash balance, monthly profit and loss analysis, and financial forecast without any effort from you as the business owner, which is obviously key. As the CEO of your business, you need to have this real time, done well, and then you can review it and make decisions. Okay, the first thing I'm going to talk about is the CFO and how to get in a virtual CFO. Now, I will show through the first 3 stages of this. I won't go into the 4th one, just given that I want to focus on the finances here and not the hiring. Obviously, I could talk about that for a long time. So first up we have is the job listing and application, and I'll show through that now. Then we've got a phone interview. We've got an assignment, which is based around the financials themselves, and then the final interview as well. So first up, if you're hiring a virtual CFO, what you want to do is hire a financial analyst and bookkeeper, and then plug them into the systems that I'm going to show you through. if you plug them into the systems, give them the power to reveal the action items in your finances and really make them a key part of your team. So this allows you to execute a hiring process that will take in talent capable of creating cash balances, profit and loss analysis, and financial forecasting specifically. Okay, so you can get an idea of the things we look at here in terms of requirements. Also, we have the outcomes as well. I can open this up. You'll see the outcomes here. So in terms of accounting bookkeeping, manage 4 accounts. So that's what we're doing at the moment. Communication, connect with your team, build rapport, resolve any issues that may be arising, and problem solving as well. So the final one here, which I think is very important with any hire, not just CFO, is that they send you a resume and a cover letter. But not only that, they tell you exactly why they're a fit for this role, because obviously when you're hiring online, and I'm sure many of you are familiar, you get a lot of people are trying to find any job as opposed to finding this job. So it's very important they tell you that. Okay, so I'm popping back into Kino here, moving on to the next one. So next one is the phone interview, virtual CFO. So I think a key part of any hiring process is going through a professional system, because this is their first touch point with your company. And essentially your company is the prize. So they've got to work through the process and you've got to figure out through this process who's going to be the best fit for the role. Now, the second one, as I mentioned, here is the phone interview. So I'm going to open this up and give you a sample of this. So the phone interview is designed not to go into specific skill sets nor competencies at this stage. It's more to test their passion for the role, their English, their ability to communicate, and the actual thought and intention that has went into their application into your role, into the job you're hiring for. So you ask more generic questions, but they're carefully chosen. What are your career goals? Again, you're looking for someone that shows passion in this area. You're not looking for someone that wants to be a VA. In this case, being a real example, an EA, you're not looking for that. You're looking for someone that wants to be passionate in finance, someone that is passionate in finance and has that experience. So what are you really good at? Again, you're trying to match it up. So we're asking what they're good at. We're trying to match that up with the scorecard. So we've created up the job listing, which has outcomes on it, which has requirements. And then we start the hiring process. We're trying to match up the answers they give to the job listing. Therefore, analyzing it based on the probability, given their answers, that they will be able to carry out the job successfully the whole way through. So it's key at this point. So other questions here, what are you not good at? What are you not interested in doing generally? Again, we're looking for someone that shows self-awareness. If it's a real person on the other end, everyone has weaknesses, everyone has mistakes, but those not willing to admit their mistakes or not willing to say that they've had mistakes in the past or areas they've not been good at, then they're essentially lying to you, or it's not a good sign in my experience. So then we go into a brief history of their job. So this is more like a higher level overview. It's not an in-depth. So the idea here is to just get some key touch points into their job history, which you will then use later in the final stage of the interview. So just to show through a couple of here, you can ask what their starting salary is as well. Now this one is a full-time hire, so it will be different for part-time if you're hiring for one company, as opposed to, in this case, hiring for multiple companies in this phone interview. Okay, so coming back into Kino here, so brief overview of phone interview. The next one here is we've got the pilot sheet. So as I said, you want to get in someone, a financial analyst that has passion for the area, that is able to carry out these tasks successfully, and how to do that as well as then give them the systems to operate. So you know with supreme confidence that they're executing on these every week, every month, and are fully prepped. The idea being behind this is that, and I'll open this up here, the idea being behind this is that you come on to a monthly financial meeting, which is what I do. So I'll come on to a monthly financial meeting with my virtual CFO, and he will run through profit and loss analysis. He will run through financial forecasting. He'll run through cash projections versus the actual cash projections as well, so we can see where there's any differences. The idea being that over time, this just gets easier and it gets more accurate. So you'll see here we have financial forecasting, profit and loss analysis. So then you can insert those specific workflows themselves in here. You have projects, and you have building in the initial steps onto Xero. So Xero is what we use, and that is why this one mentions it specifically. Okay, so that's the pilot sheet that I would have them use if I were you. Next up here is I'm going to go through a real profit and loss analysis. I'll show you Xero, what we use, and I will also show you our profit and loss here. Let me just open this up. Okay, so when you come into Xero, or when you open Xero, now there's a lot of platforms out there. I know good ones. QuickBooks is a good one. I know Sage. There's a lot of other ones as well. And usually they can integrate. My experiences with Xero, I've used a little bit of QuickBooks as well, so I know that's good. However, there are some really good ones out there. If you wanted to change to one of these, I know there's integrations out there that can basically port over the data from certain platforms. So you have your workflows, you have your data that comes out of your bank accounts, you share them across with your bookkeeper. He then inputs all of this into your Xero, into your cloud accounting software, and through that, you can then pull reports very quickly. Now, I'm going to open a profit and loss here, and we'll see. Now, of course, this is obviously a demo account, but what I will do here is I will compare, let's say, the 4 months. Again, we have our sales, our cost of sales, operating expenses, and our net profit at the bottom. Now, this is obviously very changeable, and as you'll see in your business yourself, some months you order a lot of inventory, some months you order very little inventory. So this sort of minus and plus here is very drastic changes. I will show you how to level that out in just a moment. So a couple of other neat things you can do here. You can put in obviously your percentage of trading income and your year to date. So this will show you obviously your top line sales here, but it will also show you, for example, what your cost of goods are. So these are your direct costs. So always with this and always in business, you start with the top line sales, so it's called that, and you move down. The most direct costs are the one closest to the sales. So cost of sales being your product orders. After that, it's going to come into operating expenses. These are your overheads that you need to run the business. So you could have this exported out as well. But what you can do, even with this basic setup, is try and keep an eye on the ranges of your various expenses. So if you are operating your business and you want to check in, you might have certain ranges, for example, your advertising costs, for your salaries, and so on. And that is why it's absolutely key to know these as you are navigating business. If you want to detach yourself from the business and be able to just look in with minimal effort, that's where this comes in. And that's where this becomes really powerful. However, I don't like the format of this. It's a little bit mundane, it's very gray. So let me just show you, I'll open up what we use here. So what we would do is we would export the data from Xero, and it would come out more like a vanilla version of this with a few things missing that I've added in. But the first thing you would do, the first thing I'd recommend is setting up a heat map here. And this is with the conditional formatting, because at a glance, you can see right away where the big costs are. So you can see the top line sales here. You can see the cost of sales here, or the cost of goods sold, which are here, and that is your more direct costs. We have our Amazon expenses. We have our direct material costs. These are your product costs, freight and courier, and so on. You can also see here the heat map showing up where the big outflows are. And this will potentially be similar year in, year out. Now this is for about 3 years of data, is it? About 3 years of data, so you can see the overall 3-year performance of your business too. And very easy to scroll across here and spot trends. So as you're moving down through this, we obviously have our cost of goods sold. We have our operating expenses. Again, we've got a heat map here, being Amazon sellers ourselves. One of the big ones is going to be obviously Amazon advertising. You see here. And then we've got our net profit. Now, as I mentioned with Xero, we've got these drastic changes, and you can see it on this one as well. So for example, 1 month it might be 50,000 in profit. The next month you might order a lot of inventory. Let's say you're prepping for peak and you're ordering a lot of inventory, and then it's a negative or it's a small profit. That's not really very insightful. The reason being is that it's so changeable that you can't really see the trend in it. However, what I would recommend you set up is a trailing 12 months. So I'd recommend you set up the 12-month trailing in terms of sales, in terms of gross margin. So gross margin being your sales minus your direct costs. So this is your gross profit here. So this is extremely insightful, as this is what you need essentially to run your business. Whatever about salaries and operating expenses, you need to order stock. You need to get that stock to Amazon. That is your gross profit margin. So it's hugely important. So if you set this up over a 12-month trailing, you can see the formula there. What that will do is it will smoothen out the trajectory of your gross margin, and therefore you'll be able to see very easily in your business if it's going up or if it's going down. And then you can make the necessary changes, whether that's negotiating with suppliers, shippers, and so on. You'll be able to see that straight away. So the next one here is the advertising cost of sales. So again, obviously very big on Amazon, your advertising cost. You want to be keeping an eye on this. If you wanted to just briefly check this once a month, you can do that through this. You've got your advertising cost there of total sales. In this case, there's a loan in the company, and I've wanted to include the operating costs, including the loan repayments as well, because they do not show up on the profit and loss account. Another one here to be aware of that you'll notice is the total operating expenses excluding ads, because ads can be changeable at times too. And if you want to keep an eye on these guys here, with your operating costs, you'll want to put in one that is excluding ads. So these are your costs to run your business month on month. The way to think of this as well is in terms of reducing risk in your business, how much cash do you have relative to your operating costs? Because your operating costs are keeping the lights on, they're paying your employees, they're paying yourself. And so you need to have an idea roughly in mind of how much cash you're sitting on relative to your average operating costs each month. This would be what's called operating cover in accounting terms, and it would be a ratio. So you might have 3 times that in cash, you might have 4 times it in cash. 3 times being a little bit more risky, 2 times being very risky. If you've only got 1 month's cover of operating costs, you're running things too risky. Now, on the other end of that, if you've got 10 or 11, that might be too much. And this comes down to your risk profile. So you want to be aware of your risk profile and how much cover you want to have for these costs in your business. So another one here we have is the 12-month profit. So again, is this going up? Is this going down? Key metric. And then finally, we have the net profit percentage. So the net profit percentage obviously being the bottom line and being crucially important to your business health. So you want to keep an eye on this on a 12-month trailing to see if this is overall going up or is it going down. In this case here, it's going down over the past couple of months. So not a good sign. Again, you can do things that will make it go up, make it go down, based on the cost you're seeing above this. Another thing I mentioned there was the assignment for your financial analysts. One of the things that we are doing is we will have the profit and loss here for them, obviously be dummy data, and have them run the trailing, have them run the gross margin and work out, say, operating cover and so on. Because what you want to do for the assignment stage with any role is you're obviously testing their ability to communicate in stage 2. You want to test their actual technical skills in stage 3. And then finally in stage 4, you want to test both of those except in more depth. So that's where the way that ties in. So popping back into Keynote here and going to the next slide. So the 2 main ones here, the 2 takeaways here for you guys is in the cost cut for efficiency, the financial KPIs. I would look at cash balance, inflows and outflows on a shorter term horizon. So this would usually be weekly for me across my companies. And this will just obviously see the overall cash inflow and outflow each week. And I would have my team basically make notes beside it so that you have an idea of where the large costs are coming out. Again, it's obviously good as well as the business owner to keep an eye on obviously the cash in the company as well. So long term, so you see in the profit and loss, and we mentioned the monthly financial meeting as well. So the profit and loss is obviously critical, as you can imagine. And I would look at this monthly just to give you or allow you to make changes as a CEO and maximize your impact and not just reacting when things are too late. By looking at that trailing margin, you've got an idea as things start to dip or things start to increase. In some cases, maybe you have more cash available, and then you can use that in opportunities in your business. So cash balance, inflow and outflow, and profit and loss being the key ones for your business on cost cut for efficiency. Okay, so let me just open this up in full. So the financial Midas touch comes from the ability to understand the numbers and then engineer the outcome you want. So what do I mean by engineer the outcome you want? Well, let me show you here in just a moment. So one study from US Bank showed that 82% of businesses fail because of cash flow. And I know in my experience, I'm sure Daniel, you've been the same. There's obviously been points in business where in the past when you've ordered, say, a lot of inventory, or you've needed to order a lot of inventory and you're looking at the business banking, and you're thinking, where am I getting the cash from? And being able to be aware of that before it happens is a game changer. Okay, so system 2 here, we have got forecast for scale. So in the first system, we basically brought down all of our costs, we brought our sales, then down to our costs, and now we're going to project that out. And we're going to see exactly what the future holds for your business, and then be able to optimize certain areas to, say, add in opportunities, add in profit, or potentially run things a little bit more aggressively. Maybe you drop the profit and increase, and you're going for top line sales. So I'll show you how to do that. So how we set up our financial forecast tool is in this, the workflow and how to plug your team into it. Whether you have one or many marketplaces, this allows you a vision into the future, and then from that, how to engineer outcomes that allow you to avoid crises and capitalize on opportunities as they arise. Okay, so the first one here I'm going to open up, and I'm going to open up a single marketplace forecast tool here just to keep things simple, as I don't want to add too much complexity here. Here's slides. Okay, so what are we looking at here? What are we looking at? So on the left-hand side of the screen here, we've got basically the status of the company. We've got the cash at hand, we've got the current subscriptions, we've got the annual subscriptions, and then we've got the cash at hand at the end of the month. And this is relevant. Why are you tracking both? So you can see the comparison. In this, you've got an exchange rate, so whether you're operating in Europe or US or wherever it may be, you can convert this to your local currency or the currency of your choice. Following this, I like to add in an expansion forecast checklist. So this would be based on things you want in terms of product expansion, if you're doing a foreign subsidiary, which we've done, or if you've got warehouse plans as well. You can add these in and then add them across your financial forecast. Okay, so the key areas here in this financial forecast, what's very important. I've put markers next to them and how we actually see them. So the first one being sales. So one of the best ways to do this is take your historical sales, and I'll show you historical data in just a moment, and then look at your current or your recent year-on-year growth. If you're growing by 30%, you can add in 30% here, and therefore takes your last year's data, projects it forward here, and then adds the 30% on. If you see that you're down, okay, what happens here? And also, let me just show you, for example, here. So I'm going to put this back at 0, okay? Do you see the cash? Do you see the bank at month end here? Now, if I put this at 30, it's going to be beautiful. If I put this, if I see we're dipping, this is not going to be good. Now, in the future here, we can spot this happening. Now, hopefully not as drastic as this, but it is important to know that this will be happening in real time. So I'm going to put this back to 10% here, and you can see the sales here. So the next one, obviously, we've got your refunds in there. We've got Amazon Reserve Plus as well. The Amazon Reserve Plus is when Amazon holds back funds, whether that's for returns and so on. I like to make note of this, and I know our clients have liked to make note of this that we've worked with in terms of making note. So, for example, if it's Christmas, they obviously make a lot of sales. However, if it's held back for 2 weeks, you might get a lot of that in January. Again, you can't account for that in December. So next up, we've got product orders. So we've got product orders here. And why do we have a second one here? So the reason we have a second one is because these are new products. So what we like to do is account for your current product orders. And then if we're building in, for example, product expansion here, and we've got 3 products we want to add, we can then put those in separately so that we know without the products what our cash balance is. And then, if I can press back on that. And then with the products, what the cash balance is. So you can see by adding in the opportunities or the projects that may generate sales for your company, how you can track that on the cash level and how that makes sense. So next up we've got is the shipping here. We've got shipping costs. We've got product A shipping. Again, we make note of this here. Now this one, I'm assuming if it's finished in May, we're going to ship it in June, but we can put that in here. Amazon ads budget. So you're talking to, either you're running the ads yourself or you're talking to your advertising manager. Again, what is the forecast here for the tacos or the ACOTS? In some cases, if you've got seasonal products, this is going to fall. Let's say you might be running on average 20% for most of the year, and then it drops down to 10% over the Christmas. So being able to see that and how that makes a massive difference is important. So you can see the difference it makes here to your bottom line or to your cash, which is very important. Okay, the rest of these are your operating costs. So again, good to be aware of what they are on average, and good to make note of them and how it affects your business. Okay, so the historical data is here as well. So we have the workflow here that pulls this data and sets it up nicely. And this is where we put in, let's say, last year's sales data, and then we basically project that forward in our financial forecast. So you can see here. Okay, so popping back in here to Keynote, we do have the multiple marketplaces one here, just to show you how you could set up something like this on multiple marketplaces. Let me just zoom out a bit further. Oh, that didn't open. Give me 1 second now. I'll open that up. Multiple. There we are. So let me open this up here. Let me zoom out. Again, a very similar, trying to keep this as simple as possible because you need to be able to make decisions on the fly without too much work that goes in. So again, we've added the areas here. If you have more than 2, it's also flexible for that as well. So you have your USA, you have your UK neatly done out, and that plugs right into your financial forecast, and you have your cash balance here. Okay, so coming back in here. So the bottom line here, or the main outcome we're looking to do by checking this, the cost analysis, by checking the forecast, is we want to try and disconnect our operating costs from our sales, keep the operating costs lean, while obviously growing our top line sales. And by being aware of these certain areas, whether that's your certain operating costs and salaries and so on, you can actually have a big impact on this as you grow over the months ahead. Okay, so an idea here, again, this is a workflow. If I open this up, I'm not going to go through this in too much detail. The overview here is, of course, 5 steps. You want to gather the data, you want the compilation, you want the forecast itself, then the team reviews the forecast. There's always seems to be a couple of changes. What I would usually do, on the clients do, you send it over to your, say, your supply chain manager, or if you're doing that yourself, you review that area yourself. And then they can look at the orders. For example, let me open this up again. We can open this up. They can look at this and spot check this, because it's obviously being one of the major costs for us. It's very important that this one is spot checked, and therefore, when you sit on the monthly financial meeting, that this is all ready to go, then it becomes easy. Then you can sit down and look and try and plan out the future, plan out 2023, see what is on the horizon. So that is the forecast itself there. Now, if we open up Keynote again. So the best way to predict your future is to create it. And I know that resonates with everyone here, being entrepreneurs. We essentially created our future by starting a business. So quick one I want to touch on is investors' view. So I want to give you an idea of how aggregators or how investors look at your company and how that relates to you. So I've touched on this already, and there's a lot of text here. I'm not going to go into it in too detail. But again, we've got the top line sales, we've got cost of goods sold, direct, operating expenses, which comes down, and we've got non-operating expenses, and then we've got net profit. So when people say top line, they're obviously referring to the top of the financial statement. Visualize working down the statement, taking each section. The further you go down, as you get down to operating expenses, non-operating expenses, the less direct the cost. So this helps you understand the core business first and then branches out. Investment funds would acquire debt-ridden companies or lawsuit-ravaged companies if the core business remains strong. So for us, what that means is the aggregators obviously look at our sellers' discretionary earnings. They want to look at the core of the business and how it's performing. So they will obviously add back And I'll touch on add backs later and valuations. So the next thing here we have is the demonstrations. So I want to show you how you can look up maybe some of your favorite companies online and what that means. So how to look up any big company or company that's trading in America, which is most of the big companies, online and get their real financial data is by entering the word 10K after their name. So for example, I'm going to type in Amazon 10K 2021. So every company releases an annual report. So what happens is when you type this in, if you see Amazon, they've got their own annual report, but these are heavily biased. There's a lot of images and fancy writing. What the SEC asks for is they ask for the actual data in very boring, mind-numbing, raw data, but it is the actual data. There's no bias, there's no fluff on it. So I'm going to skip straight down to the financial statements. So you can do this for any of your favorite companies, Amazon, Microsoft, so on. And I will skip straight down to financial statements. So I've gone down to financial statements. I'm going to go past here. This is cash. You don't need to know anything about that. And I just want to show you here the top of this, because what we've just showed through is how every other company in the world is managed and how aggregators look at your company. So you've got your net sales at the top here. If we can not slide across. Then we have our operating expenses, again, cost of sales. They have that here. And then, so we have cost of sales in ours as well, as we see them, cost of sales. And then we have our operating expenses as well. So operating expenses being here. Let me see if it'll let me select this. So these are Amazon's operating expenses in 2021. And again, then as you go down, you can see sort of operating income, interest expense, the ones that are non-direct. They're not as direct for the business, not as important. However, they are there for people to see. Okay, so popping back into Keynotes and moving into our next slide. So by the man himself, Warren Buffett, you have to understand accounting. You have to understand the nuances of accounting. It's the language of business, and it's an imperfect language. But unless you are willing to put in the effort to learn accounting, how to read and interpret financial statements, you really shouldn't select stocks yourself. So from an aggregator's perspective, these are the things they're really looking at and digging in to your business on Amazon. Okay, system 3 we have is the risk reduction. So this system allows us to analyze products from a cash flow perspective, how this relates to our ability to expand more aggressively. So how operating cover as a ratio is your risk tolerance in running your business, how ROI built into landed cost and margin analysis for new products is crucial in deciding the next product you launch. So what this means for cash flow and why the ROI is important. And then finally, we'll talk about setting up credit facilities to reduce risk and smoothing out your cash flow. Okay, so cash is king is a very poignant statement, and cash is king at certain points during the economic cycle. Cash being king now, if obviously all of assets are coming down, that's when cash is king. Prior to that, during our boom that we had, cash is not king. You want to put it in assets that are appreciating. So that's why this quote is very poignant and why it is heard in every financial course. Okay, so I've got Amazon here. And this, I want to just run through this and what we're seeing here. So we have Amazon's actual revenue versus their net income. You can see that the bright red line is their revenue, and we can see their net income, which is their net profit. So we just talked about the net profit on the bottom of the P&L, and this is Amazon's net profit for the first 17 years of their business. So revenue massive, we're talking 45 billion at the peak there in 2015. Net income still break even, not profitable, or if they are, barely profitable. So I would ask, and I would like if you could put it in the chat box if you can anyone tell me why Amazon have low profitability for the first 17 years in business? I can give you my opinion. There's two things that come to mind here, which I will talk about in just a moment. Okay, do we have any comments in the chat box, Daniel? If we have none there, I will reveal myself.
Yeah, so far no one's taking a stab at this.
Okay, okay. So the number one reason, and this is my opinion, is of course tax efficiency. You pay corporation tax in your company based on your net income. So Amazon hopefully won't sue me, but they are obviously running a tax efficient business, keeping their net income low. But with that said, this only makes sense if they're putting that money into their product moat. And their product moat, as described by Warren Buffett, very old school term, is a moat is around the castle, right? So you've got a castle, you've got a moat, it makes it difficult to attack. So Warren Buffett only acquires companies that have a strong moat around them. So Amazon, for the first 17 years, were investing all of their excess profit into their product moat. And why do I think this? Is because I have the profitability from 2015 onwards, and you can see the massive rise. So from 596 million in 2015 net profit to 33 billion in 2021. So they've basically like exponentially increased their profit each year. So if anyone is able to say Amazon could not make a profit in the first 17 years, I would heavily disagree. I think you're wrong. And the evidence is that how much they've increased their net profit since 2015. They basically could not contain anymore the profit, and they built out their product moat enough to the point where it's very difficult for other e-commerce retailers to compete with them, as we know well ourselves. Okay, so next thing I'm going to talk about is the cash conversion cycle. So each rotation is an ROI. So in our business, as we know and as you know, we obviously start off with cash. We pay our suppliers for products. The products get shipped. We hold the inventory, and then we sell the inventory and we get the cash back. So each time we do that is an ROI, a return on investment. And we obviously want to make as many rotations as possible. So I'm going to talk about the cash conversion cycle. So the time it takes us to convert our cash that we're holding to obviously products, to inventory, to sales, and back to cash again, and how this will affect your ability to grow your company. So why this is important. So return on investment. So when you purchase products and shipping, you have the cost of goods sold or investment, which we then put through the Amazon machine, which spits out our return. So our total payout relative to the investment is our ROI. So how is this calculated? Total landed cost, so the cost it takes in product costs and shipping costs, then plus our net profit divided by the total landed cost is the ROI ratio. So the landed cost and margin analysis, when comparing products, ROI is important because it is your multiplier for flipping cash. So you grow at the rate of your ROI in your business, and everyone has probably an average rate. Even with multiple products, there is an average there. So the cash conversion cycle is compared. So we have a 90-day cash conversion cycle with a 2 return on investment. And we have an 180-day cash conversion cycle with a 2 ROI as well. And I'm going to show through the difference this makes in cash if opportunities are abundant. So the yearly return, the cash conversion cycle is 180 days. So if you start off with 50,000 investment in inventory with an ROI of 2.0, example, you trade 50,000 in cash for 100,000, you do that twice, it will leave you with 200,000 at the year end and 100,000 profit. So you can see that in the 2 cycles there. So that would complete our year. We've invested 50,000, turned into 100,000, and then flip that again to create 200,000. If you want to grow fast, you must choose opportunities that put in place terms that allow you to complete flips faster without going out of stock. So the 90 days, so we're taking every other factor is the same here. We're just condensing the cash conversion cycle. Instead of 180 days, we've got 90 days. And what does this look like in terms of growing your business? So if we take 50,000 investment in inventory with an ROI of 2, you traded 50,000 in cash for 100,000 4 times this year. This would leave you at 800,000 at year end and 400,000 profit before operational costs. So we've invested 50,000 to 100, 100 to 200, 200 to 400, 400 to 800, and that creates 800,000 in sales or in seller proceeds. This is the difference of 600,000 based purely on the difference it takes to complete our cash conversion cycle. So we see a difference here from 200,000 to 800,000 in just based off how quick we can turn over our cash. Now, this is obviously hugely relevant in choosing products where your suppliers are based and then optimizing that. So ROI and stock reordering points. So if you want to grow fast, you've got to make use of your cash in high ROI opportunities, and I'll explain why. So staying in stock is massively important for overall profit margins. We know once we go out of stock, sometimes you have to pay an ad cost to re-rank for organic traffic. Why ROI is important, regardless of net profit dollar amount. The amount of time it takes to receive your initial investment back is 100 divided by your ROI equals the percentage of sell-through. So for new product lines, comparison example number 1, if we're looking at a 3x ROI project, the time it takes to receive the landed cost back is 33% sell-through. So 100 divided by 3 is 33%. Because we're getting 3 back for every 1 we put in, we only need to sell 33% of the order amount, of the amount of units to get our cash back. But if we have in product line 2 example, if it's a 1.4 ROI project, the time it takes to receive the landed cost back is 66% sell-through of the goods we've ordered, and 100 divided by 1.5 is 66%. So in an example here, if we ordered 1,000 units, we would have enough cash flow to reorder the same quantity of goods when we have 667 units remaining at 3x ROI. So this is obviously easier to keep in stock. If we had example 2 here, if we ordered 1,000 units, we would have enough cash flow to reorder the same quantity of goods when we have 333 units remaining at 1.5 ROI. So this will be difficult to maintain. If we've sold already close to 700 units, we've only 300 left, it's going to be more difficult. So this is where ROI comes in. You also need to consider if you need to order more units than the original order, then you'd need to wait longer than the original landed costs. So looking at example 1, you've got 1,000 units. You're able to order when you have 667 units, or when you've sold 333 units, you have enough cash that you have the same amount of cash that you paid initially. Now, if you were to order before that, let's say you order at 200 units sold, you're operating a negative cash action there. As in you're ordering, what you have to do there is you have to take money from your existing business and put it into this to reorder stock. If you waited until after 333 units, you've already got more cash back. So it's positive. You're basically taking money from that initial investment and putting it back in. So you're reinvesting it. So that's why it's very important that you are aware of the ROI when you are ordering products, because if you want to do more flips, you're going to have to flip the cash, and you need to do that in high ROI opportunities for stock reasons. Otherwise, you will go out of stock. Okay, so you need to have a lot of cash to take advantage of low ROI opportunities without going out of stock. So here's an example here of a product opportunity we had. This was last year. So we have a container load in both of these. No, we don't. So we have we have product 1 on the left and we have product 2 on the right. Product 2 was a lot larger that we had to consider. And we can see here, if we work down from our initial order and we take into consideration the costs, we can see here that the total landed cost for this one was 7,000 investment on the left, and the one on the right, it was 33,000. So it's 33,000 on the right. And we can see here the net profit margin. So we can see the one on the left is 38% net profit, the one on the right is 25%. However, the one on the right has a larger dollar net profit margin. So it has $42 or $43 compared to 15. So if you're looking at this on purely based on dollar terms, in terms of profit it's going to make for your business, you would obviously go for the one on the right, because $42 is better than 15 per unit. However, the ROI on the one on the left is 3.2, and the ROI on the one on the right is 1.7. So the sell-through rate on the one on the left is 31, and the one on the right is 59%. So we would need to sell through basically 60% of the units on the right to be able to reorder the stock with that initial money. And we can see the landed costs here were 33,000. So that's a hell of a lot of money to reorder. So even though the product opportunity here that we were presented with had a higher dollar net profit margin, we went ultimately for the one on the left because we knew we would be able to sustain it in cash. We knew we'd be able to reorder more stock at an earlier stage and therefore not take away cash from the existing business. So this is a way of investing your cash in a better cash position. So high ROI is quicker to grow and easier to manage cash flow. So something to consider when you're looking at and comparing products. So if you want to outpace the competition, grow faster and make the, if you want to outpace the competition and grow faster, make the wheel spin faster or shorten the track. So what do I mean by this? So as you've seen here, and people may be familiar with this, we've got a cash conversion cycle. So I touched on this earlier, obviously cash to purchases, to inventory, to sales, back to cash. And the length of time this takes is affects our ability to grow. Obviously, the shorter this is, the quicker our flips for cash is, and the quicker we can grow. So there is some ways you can affect this. And the first one I will start is on the top right here, and that is invoice discounting. So there are service providers for this. And instead of Amazon's usual 14-day payout period or bi-weekly payout period, the provider will actually pay you out daily based on your sales on that day. And they will take a very small percentage for this, but it's a way of shortening that cash conversion cycle by up to 14 days. So that's something to consider. The next one I'll talk about here is short-term facilities. So this is credit cards, line of credit / overdraft if you're in Europe. While it is not hugely beneficial, or I wouldn't recommend using it specifically in ordering stock, unless you are ordering a large amount of stock for, say, peak. This might be Q4, maybe if you're summer seasonal, maybe before the summer. What this does is, and as people are probably used to, is that when you have to order a lot of stock preparing for Q4, what happens is you have this massive drop in cash for your business. So you're essentially like your operating cover goes down a lot. And again, it's potentially risky. It's not good for your business health to be down in cash so low. So the way to smoothen this out is to access short-term facilities. Again, the credit card rate is going to be higher than, say, an overdraft or a line of credit, which I would recommend. And this would mean you can then order that stock on or using the short-term facilities. And therefore, your cash balance will stay very smooth the whole time, which is hugely beneficial for you and your business. So the next one we've got here is supplier credit terms. Now, this depends a lot on where your supplier is. So if you're working with a foreign supplier and you're using the usual terms, 30/70, what you need to consider here is potentially upgrading or talking to your supplier about 50 and 85, or 50 and 85 deposit and balance, or also potentially freight on board, and that is paying for your goods when the bill of lading is issued. Again, potentially shortening your cash cycle by 10 to 15 days. If you are working with a domestic supplier, as in it's in Europe, the country that you have your business, or it's domestic, you can access terms net 30, net 60. What I mean by this is you pay for the goods only 30 days or 60 days after the goods have been completed. After production is finished, that's when the clock starts and that's when you pay. So you can potentially shorten your cycle by 10, 30, 60 days, depending, in some cases more, depending on the relationship with your supplier and the facilities available in your country. So that is the supplier credit terms. As far as the shipping credit terms, so if you are currently paying for your shipments in advance, it's not a good thing to do as far as cash conversion, because you're tying up your cash in your in the shipment, and that you're not actually selling the units until maybe 30 days later, 60 days later. Again, that's a cash strain in your business. What you can do here, and I know there is providers that do this, is you can get, and what we've got as well, is you can get like net 7, net 14, net 30, maybe in some cases net 60 as well, would be possible. And this means that you pay either 7, 40, and 30 days after berthing. So after the product arrives at the destination port, that is when the clock starts in terms of when you have to pay. So you're given a lot of leeway to pay that, and therefore you are shortening your cash conversion cycle by holding onto that cash yourself and only paying very close to when you're able to turn that cash. You're only paying for the shipment when it's close to Amazon, and therefore you're getting that back immediately then. Now, a couple of the other ways here, which are less based around service providers, but equally and if not more important as well, is the sales velocity. So an ability to keep enough cash in your business so that it's ready to go with opportunities that arise is obviously your sales velocity. So ways to alter your sales velocity, as you know, increasing your price. If you've got a project that comes up or a product that comes up that is highly lucrative, high ROI, and you need to invest in that, you might run a discount or you might run a coupon and try and get that cash into the business, even if it may be at a lower, let's say, a profit margin. Because even if your usual profit margin is 30%, but you run a 20% discount, it's at 10%. However, you bring in a whole lot of cash that you can then reinvest in another product opportunity that has a higher net profit margin. This is going to be hugely beneficial for your business. So something to really consider is the sales velocity, and as far as that affects not only the profit in your existing product, but then how it can be used in other areas of your business. And the final one here is the quantity of inventory. So ordering the right amount of inventory is very important as far as inventory planning. If we order 12 months of inventory or 18 months of inventory, we have just tied up all of our cash in that one area. So trying to get this right, as in enough that you're comfortable, but not too much, is the key balance here, so that you have cash available in your business and therefore are shortening the cash conversion cycle. Okay, so very quickly, I'm going to talk about Apple as an example. So Apple have a negative cash conversion cycle. So this is a massive positive. Yes, you read this right. So what does this mean? Apple actually takes in sales revenue before it pays its suppliers. Thereby, it doesn't require any upfront capital to make a profit. So they do this by arranging purchase agreements with suppliers, allowing them to pay 60 to 90 days after the goods are already delivered. So they have shipping net terms of the same. So they have, in our case, and what we're looking to enhance, is they've got no capital constraints in the business. They are taking in the sales revenue before they actually even pay for the goods. So therefore, they have a negative cash conversion cycle, and it's hugely beneficial. So we want to enhance our cash conversion cycle using the metrics we just talked about, so that we can move towards a better cash conversion cycle that's shorter, allows us to grow faster and reduce risk in our business. So the graph here shows some of the data on that, or Apple operating at minus 53 days. Thereby, they sell their iPhones, they sell their Macs, and then they pay their suppliers up to 50 days later, which is pretty crazy. So scripts for credit. So we have scripts here for credit. Now I'll briefly talk through the shippers one that we can see here. So I've added general talking points here, how you should approach your partners for favorable payment terms and short-term facilities for your bank. So one of the ones here we've got is obviously shippers, and a shipper that provides this off the bat is Freightos. So if you are not already operating with payment terms, I'd highly recommend you talk to Freightos, and they will offer net 30. So you may need to start off with net 7 or net 14. But this is, as I mentioned earlier, payment after purchasing, and you want to really work with your shipper. And as you establish a history with this one shipper or with a few, you'll obviously get better terms. You can ask for increases. You can ask for more cash allowance on your terms as well. So they might give you, say, $20,000 at net 7, and then maybe you can move for $30,000 at net 30. And over time, you can get better terms. So this is why, in a lot of instances, it doesn't make sense to be constantly changing shippers based on the price you're getting, because in some instances, if you've got a really favorable payment terms, the cash is going to be worth more than that small amount of upfront payment, or the small difference in the shipping price. So we also have suppliers there as well. So I'd recommend approaching the various vendors that we mentioned on the previous, whether that's your bank, whether that's your suppliers, whether that's your shippers, and approaching them about better payment terms, because they are available to you now and you can access them. So the next system we've got is your financial leap. So this system shows you how to take a financial leap through raising finance or selling your company. So how I've accessed debt from my bank for product expansion, how you could access investment, and how to know the right questions to ask. And then finally here we've got value in your company and going through the sales process to maximize your exit and tax efficiency. So what we all like is a highly efficient exit with lots of high valuation. So I've added in raising finance into the cash conversion because I want you to think from the perspective of we've got our flips, we've got our ROIs, we're flipping on the ROI with the time it takes, but then also why raising finance makes so much sense. Because you're basically just adding gasoline to the fire. If you've already got a lot of opportunities in your business and you obviously add, let's say 100,000 in cash or 500,000 in cash or 20,000 in cash might be the case, you will just basically add gasoline to the fire and it will just grow at a faster rate. So you, by looking at, as we mentioned, system one, by looking at your costs, then projecting them forward, by looking at how much, say, operating cover you have, how much financial space you have, like your net profit, and how that looks over the 6 months, makes it way less risky in terms of asking your bank for money, because you already know the costs that go into it, and you're able to put them in. So cost of debt versus equity. So in this graph, we can see, so equity being investment. So if you were to sell a portion of your company, take on investment, they're going to acquire shares in your company, and why this can actually be more expensive in the long run versus accessing finance from your bank. Why the cost of debt stays flat while the cost of selling part of your company is a lot higher. So in an example here, you have a company, it's worth $1 million. And this is equity here. You give up a portion of that for investment and an advisor. So with an investment, you would usually use it for the advisement as well. So the investor gives you $75,000 for 10%. In 3 years, the company is now worth $3 million, and he owns the 10% stake that he bought. So the investors own $300,000, or the investors own $300,000 of your company. The cost of equity was $225,000, although you did not actually pay him anything. So yes, you didn't pay him anything, but when you sell your company for $3 million, you're going to receive 2.7. So the actual cost was the 300,000 minus the money you got, because he gave you that money, of course. So the cost of it here is 225,000. If you were to do debt, if you were to ask your bank and say, look, I need a loan of 10,000, I need a loan of 50,000, they obviously don't take a portion of your company. So in this example, your company is worth 1 million, but you take on debt of 75,000 to fund a new product launch. The total interest cost is 5,000, and you pay back the total 80,000 over 3 years. You manage to invest in high ROI opportunities, and you grow your company with clever decisions to a value of 3 million. The cost of debt remains the same. So the 80,000 stays the same. When you sell your company, in this example, 3 million, you will receive the full amount. So the only cost of debt, as we've seen, was a flat line. So that's the 80,000. Whereas the cost of equity in that example was 225,000. So that is something to consider as far as the costs if you want to add more fuel to the fire in your business. So what is the right solution in that, in terms of the investment versus the accessing debt? So it depends on your situation. The debt solution was right if you were capable of reaching that valuation without any outside help and you had the financial space to pay back the debt. So if you didn't need any help, like you didn't need any advisement, or you didn't need any knowledge that the investor had, and you could basically grow your company to 3 million by yourself, then debt is the best, or with the money from debt, then debt is the best way to do it, because you don't need that extra help. So with debt, you were capable of reaching that valuation without any outside help, and you had the financial space to pay the debt back. You maintain control and get paid 100% of your exit. So equity was better if you would not have reached that valuation without the outside help and the resources the investor brought. So 100% of 1 million valuation, if you decide not to take on equity, while the company does not grow, is less than, if you did take on the investment, is less than 90% of 3 million. So it's less than 2.7 million, obviously. So the idea being you can hold on to 100% of a small pie, or you can have a smaller allocation of a larger pie, but actually be worth a lot more money. So that's your decision there. That's the thought process. So, and to illustrate that with a quote from John F. Kennedy, a rising tide lifts all boats. You take on that investment, obviously the boats rise, your company valuation rises, and everyone wins. The valuation is increased. So raising finance debt. So I have just a couple of graphs here just to show you. So the basic steps for this is, first up, you review your opportunity. So you might review your opportunity, see what the ROI is, see what the net profit is, see what the cash conversion cycle is. Know that this is a good opportunity. You want to apply at your bank, you're going to submit documents, you're going to sign a guarantee, and you're going to receive the money into your bank account. So that's the simple process. Now, one thing to consider is, as far as submitting documents, they'll usually ask for a business plan. So there is, you can Google this, find this yourself, but there is business plans out there, and you will need to fill that out and basically use that supporting your application to access the finance. Next one here is equity. So similar 5 steps process. So review your opportunity, contact your network. So obviously being in the FBA industry, we obviously get contacted by lots of aggregators all the time. Some of those want to acquire your whole company. Some of them want to acquire a large portion of your company and keep you on. The next step after that is pitch investors. So you'd obviously pitch why your company is a good idea. You sign the documents, you receive the money. But not only do you receive the money, as we mentioned a moment ago, you receive the knowledge, you receive the resources, and you receive the network as well, as far as the investment. So there's a pitch deck here. So I'm not going to go into this in terms of time, but I'll briefly open it up, show you through it. So again, what's the problem we have? What's the problem in numbers? Our solution, how it stacks up, so why it's a good investment, your vision, what that means for them as far as valuations, opportunity, and so on. Again, it's very short because you don't want to have too long of a slide deck when doing a pitch. Okay, coming back into here. So as we mentioned earlier, here's the quote by Warren Buffett: a good business is like a strong castle with a deep moat around it. I want sharks in the moat, I want it untouchable. So this is why Warren Buffett, I believe recently, said something along the lines of, even if there's a recession next year, he's acquiring the same companies now, it doesn't matter, or he would acquire them next year, because these companies have a product moat. These companies are the best at what they do, they're hard to compete with, and therefore they're going to win in the long run. And like we know so well, it's on Amazon, it's the #1 ranking, or the #1 product that does a lot of the business. #2 does some business. The rest after that, it's a little bit difficult, more difficult. 3rd, 4th, 5th best, that's more difficult, particularly if you go into a recession. That's when it becomes difficult for those, whereas the best, there's always business available. So that's why Warren Buffett does it. That's why you should invest in your product moat in your business and potentially take on capital if you need to. So company valuation. So what have we got prepared here? So we have a company valuation tool. So this system is to get an understanding of your valuation, so you can understand the idea of your progress so far. So if you are to sell your company or take on investors, this is an idea of your current valuation for issuing shares. So this is an idea of your current valuation for your company. So if you wanted to grow your company with a sale in mind, or maybe you just like doing it to track the progress, this would be a way to build it out. So you want to pull out your P&L, you want to obviously add your add backs in. So why do aggregators allow add backs? So the reason that aggregators allow add backs is because these are costs that they will not incur once they acquire the company. So that's why they allow you to add back your salary. That's why they allow you to add back, in some instances, international travel or expenses that you ran up, whether that's meals, entertainment, so on. Again, these are negotiable with aggregators, and why they allow to add them back is because they're not going to incur them the year after, or they're one-off costs potentially. So this takes the net profit, adds your add backs, builds out a seller's discretionary earnings, and then you've got your multiple. So multiples were obviously higher in years that gone past, maybe 3 to 5. Now, from what I understand, it's about 2.5 to 3.5. Company dependent, of course. If you have a really unique product moat in your company, you're hard to compete with, you're going to get a high multiple. There's no two ways about it, and that can come in many fashions. So in this case, we've got 200,000 sellers discretionary earnings. We've got a multiple of 4, gives us a total of 849,000. Then we get the add back the inventory value as well. If you already have stock on hand, you can add that right back. and it will give a valuation of your company, in this case, 924,823. So selling your company, so if this is an area that you're interested in sometime in the future, then listen away. So there's two ways to sell your company. The first one is your asset purchase agreement. So if you are USA based, aggregators will opt to purchase your company's assets as opposed to purchasing the shares themselves. So the assets, when someone purchases just the assets of another company, they do not take control of the LLC or the limited company shell remaining. They purchase the brand, so this might be the trademark, the intellectual property, and then the inventory as well. So the risks involved, they purchase this to take under their company. By not purchasing your LLC or limited company, so by not acquiring shares in your LLC or limited company, they don't acquire any debt or potential skeletons in the closet. So let's say you had like legal pursuits or debts. And so as I mentioned there, this means it is simpler and cheaper as they don't have to conduct the in-depth due diligence required to assure they are not acquiring any legal pursuits or debts. So it just makes it simpler for them, it makes it less risky. So the second one we have here is share purchase agreement. So the purchase agreement is the share purchase agreement is when the acquirer, the aggregator, purchases all of the shares of the company to take over the LLC or limited company. So they acquire the corporation itself and in turn all of the assets too by default. So the risks involved here. So this is obviously a lot more risky. So it involves more risk for the purchaser. They don't know how you've been running your company over the past few years. If you got into legal issues that are pending, taxes unpaid, by purchasing your LLC or limited company, they acquire any debt or potential skeletons in the closet. So simplicity, this is more difficult as they have to conduct in-depth due diligence required to assure they are not acquiring any legal pursuits or debt. So when you sell your company as well, how to be tax efficient here, when you sell your company, there is some schemes that are available. So when you sell a company, stock or asset, you're subject to capital gains tax. This is basically a tax for selling assets, different from personal income and corporation tax. So the tax scheme is in Ireland and the UK, and potentially more of Europe as well. You might want to look up your country, maybe some options available in the US too. So do look this up. So they have a 10% scheme in the UK and Ireland. So this offers benefits to entrepreneurs selling their company. I think it's their first company in usually in cases via share purchase agreement. So this means selling the shares in the company. So usually, so as opposed to them purchasing just the assets. So usually CGT is 30% plus, so it's capital gains tax. So this is a massive saving, reducing it to 10%. If you sold your company for 1 million in the UK, you would only pay 100,000 in tax compared to the usual 18% through this scheme. If you sold your company in Ireland for 1 million, you would pay 100,000 compared to 330,000 normally in Ireland. So obviously me being Irish, having an Irish company, this will be massive for me when I have my first exit. So smaller aggregators are unwilling to purchase via SPA as they don't have the resources to do due diligence. So if your company has a lower valuation or there are only smaller aggregators interested, then purchasing via the shares, so they don't want to acquire the limited company or the LLC. They want to just acquire the assets themselves, as they just don't have the resource to do due diligence. They will only purchase via asset purchase agreement, which is them just acquiring the assets with less risk. So final here, so your involvement after sale, what do you want to stay on as a shareholder to capture upside in the increase in valuation? Actively manage your company or sell outright is up to you. And finding the right aggregator. So some aggregators will favor different models. So it's really about matching your terms to the right buyer. And what I mean by this in terms of finding the right aggregator is to some aggregators, your company is going to be more valuable than others. So for example, if you have, let's say you're in garden and outdoor, and they already own many companies or many brands in garden and outdoor, the fact that they could acquire your company is hugely beneficial because they can obviously cross-sell with email lists. They've got related knowledge in that area, and there's a lot more synergies available compared to them acquiring like one brand in garden and outdoor and one in like some random other niche. There's no synergy there. So being able to find the right aggregators, and I've talked to 5 or 6 aggregators this year, they all have different investment mandates, is hugely important for increasing that exit and getting your valuation. So what I've shown here in the previous slides, I've shown how to record historical data in a scalable way, projected forward trends, leaned out our costing, and we can now spot and create opportunities for growth. We've minimized our risk by access to financial oil. This is in terms of credit facilities and credit terms for a cash cycle, and revealed how to take your financial quantum leap by financing or selling your company. So I hope, I'll pass it over to Daniel now, but let me just say, I hope this was insightful to you, and I hope you've got a lot of value here to take away and potentially implement in your business.
All right, so I hope you enjoyed that presentation from Shane, and it gives you some great insight into this part of your business, and you learned a lot. So we do have a program that actually goes through this in detail, where you could work with Shane to implement these things into your business, even get access to a lot of pre-made things. So it's more plug and play, and it's really cool. Like, if this was valuable for you, then that's definitely going to help you a lot. It's just basically a shortcut to implement these things properly into your business, get it right straight away, and benefit. So if you are interested in that, I'm going to have a link here below this video so you can actually opt into our waitlist. So we open this periodically, and we go through it in sort of like a mastermind setting as well. So if you are interested in that, you can opt into the waitlist, and then we'll email you next time we open this up and do it again. So that's it. Again, I hope you really enjoyed this presentation and got great value from it, and it gave you inspiration and insight into this part of your business. So that's it, and talk to you soon.